Hello friends, in our last lecture on Indas2 we discussed about what can be included in inventory, what can be included as part of cost of inventory. That is what we have discussed in the last lecture. Okay. Now in this lecture we are going to proceed further and we are going to discuss about para 21 to 27 of Indas2. Now in these paragraphs the standard talks about the various techniques for ascertaining cost, the methods which we can use for ascertaining cost, and the various cost formulas which can be used for ascertaining cost. Now what are these techniques and methods? So we can simply say that these are approximation techniques. That means if you want to arrive at the cost of production, or if you want to arrive at the cost of inventory using a shortcut, you can use these shortcuts or more efficient ways of arriving at cost of inventories. Okay. So the standard has given you certain techniques. One is standard cost method and the other is retail method. What is standard cost method? See, the standard cost method is generally used for arriving at cost of unsold finished goods which were produced during the year. You want to arrive at cost of production of stock of semi-finished goods which are produced during the year but unsold at the end of the year. You want to arrive at cost of stock of finished goods which are produced during the year, cost of production of semi-finished goods which are produced during the year and unsold at the end of the year. What standard says is you can take the help of standard cost method. Now what is standard cost method? The management will try to estimate in normal circumstances for producing 1 unit of product, what is the normal cost of raw material that is required, what is the normal labor cost which is incurred for producing one product, what is the we can say production overheads which are incurred for producing per unit of product in normal circumstances. So using normal level of efficiencies, normal consumption, normal capacity utilization, what would be the cost of production per unit is estimated by the management, and this is used for valuing the stock of finished goods which are unsold at the end of the year. This is used for valuing the stock of semi-finished goods which are unsold at the end of the year. So management considers in normal circumstances what is the normal cost of raw material which is included in per unit of finished product, normal labor cost to be incurred to produce 1 unit of finished product, normal production overheads variable and fixed to be incurred to produce 1 unit of finished product. So in normal circumstances what will be the normal cost of production per unit, that is used for valuation of the closing stock of finished goods which is unsold and the closing stock of work in progress which is unsold. So these are approximation techniques. And what the standard says is these standards have to be reviewed on a regular basis, and where you find that the actual cost is very different from the normal cost which we are using, in such cases we have to revise the standards and use it for valuation of inventory. So the standards have to be reviewed regularly, and where you find there is a difference between actual cost and the standard cost, the standards have to be revised. Okay. Now I will give you an example where we can use the standard cost method. I am taking the example of a company. So there is a company which is engaged in the business of manufacturing galvanized steel products. Now I hope you know about the transmission towers which are used for transmitting electricity from one place to other place, the huge transmission towers. Those transmission towers are made of steel angles. Those steel angles are produced out of steel blooms or billets. Billet or a bloom is a huge bar of steel which is melted, or which we can say which is heated, and then it is made into small and slim steel angles. These steel angles are dipped in hot boiling zinc to form a zinc layer on it, and some holes etc. are put so that these steel angles can be erected in the form of a steel tower. Now this company which I am talking about manufactures galvanized steel angles. Their business is to buy billets, make them into steel angles, put that steel angle into hot boiling zinc and to make it into galvanized steel. Now these galvanized steel angles are used for manufacturing of those towers. Now at any point of time, if you go to their inventory yard, you may find that there are some 1000 tons of galvanized steel products. That means the production process is complete. The steel billets have been melted, they have been heated and they have made into steel angles. Holes have been put and the shape is according to our requirement, and they have been dipped in hot boiling zinc as well. That means there is a layer of zinc as well. And you may also find that in inventory yard you have some ungalvanized steel products as well. That means the billets have been converted into steel angles, but the zinc layer is not yet formed on those steel angles. So we can divide the output, or we can say the inventory can be into two types: galvanized steel, ungalvanized steel. Galvanized steel is where the zinc layer is already formed. Ungalvanized steel product where the zinc layer is not yet formed. So how do we value them? The simple example I have been given. Suppose I have 1 ton of galvanized steel products and 1 ton of ungalvanized steel products. So how do I value it? I will say steel cost per ton 40,000 rupees per ton, both in galvanized and ungalvanized. Zinc is used only in galvanized product, hence zinc will be included only in the cost per ton of galvanized steel. Whereas in the case of ungalvanized steel, the zinc layer has not been formed, the steel product has not been dipped into hot boiling zinc, hence I have not included zinc cost in ungalvanized steel. Conversion cost I have included 5,000 rupees per ton and 2,500 here. Why I am taking less here? Because there is still some conversion process which is yet to be complete. We have to incur some more cost to make them into finished goods. Hence I am assuming that if there is some stock of ungalvanized steel per ton, the conversion cost incurred is only 2,500. So if I now take the total galvanized steel, the cost per ton comes to 50,000 rupees, whereas ungalvanized steel it is 42,500. Now using this, what I can say is at the end of the year, suppose I have 500 tons of galvanized steel. I will say 500 tons into 50,000 rupees, I will get the cost of production for galvanized steel. Suppose I have 1000 tons of ungalvanized steel. I will say 1000 tons into 42,500, I will get the cost of production for ungalvanized steel product. This is finished good, this is semi-finished good. So who has fixed these numbers? The management has estimated what would be the steel cost per ton, what would be the zinc cost per ton for galvanized, ungalvanized, what would be the conversion cost for finished product, and what is the conversion cost for semi-finished product. These estimates are done by the management, and this is used for valuation of the closing stock. Now, if the actual cost is very different from what we are doing, then the management would have to revise the standards. This is an example of standard cost method. Next, we go to the next method, that is retail method. Who uses this method? In the case of retailers who are dealing with large variety of rapidly changing inventory. Now if you go to a big retailer like Bharti, we can say Reliance Retail, Big Bazaar, or you have other retailers as well, Walmart. Now in the case of these retailers, they are dealing with huge variety of goods. The number of variety is very huge and the goods are rapidly moving. That means the stock which is purchased today may not be there in our godown or may not be there in our showroom in an hour's time. So the goods are rapidly changing. So we can say this method is used by retailers who deal with large variety of goods which is rapidly changing, and the stock quantity will rapidly change. Now in the case of these companies, it is very difficult to arrive at cost per unit directly. It is very difficult to find out what was the purchase cost for these goods. Hence standard says we can use an indirect method, that is, take the selling price of the inventory, subtract the estimated gross margin percentage, you will arrive at cost indirectly. Now how to arrive at margin? The standard says every retailer would be aware of what is the margin he is going to make when he sells one product. So he has to take the selling price of the product, subtract the estimated margin to arrive at the cost. But to arrive at the margin, standard says you have to keep certain things in mind. Sometimes certain goods are marked down below their original selling price. That means you have some slow moving goods, you know that these goods cannot be sold at their original selling price, you have marked them down. So in such cases, the gross margin percentage which you use should consider the markdown of such inventories as well. And what happens is generally the retailer will divide his organization into various departments, and for each department where there will be a separate gross margin percentage, and that gross margin percentage would be applied to arrive at cost for that particular department. So the retailer will divide into various departments his organization, and for each department will find out the estimated selling price of the goods, subtract the estimated gross margin percentage for that particular department to arrive at cost of the inventory. So this is an indirect method. Okay. So we can say these are approximation techniques where we can arrive at cost approximately, where the approximation technique is not giving you approximate figures and you feel that the cost of production because of these methods is not equal to the actual cost, then you have to revise the approximation techniques. Now let us go to the various cost formulas which are prescribed. As per the standard, the cost formulas prescribed are under AS from para 23 to 27. Now the various cost formulas prescribed are specific identification method, Fifo method and weighted average price method. Now what are these cost formulas? Now listen to me. In inventory, I have various products which are in inventory, and in costs, I have various costs. Now I'll try to make you understand these methods in a very simple way. See, you are purchasing goods at various points of time during the year, at various prices. The goods are not purchased or procured at one single price. The goods are purchased in various batches, many number of times during the year, and the price you pay each time is different. And at the end of the year, some goods are unsold. It is very difficult to determine at what actual cost these goods were purchased at. So it is very difficult to determine the batch from which the goods are remaining. It is not easy to find out from which batch the goods are remaining and what was the price which was paid for these goods when they were purchased. So it is difficult to arrive at one-to-one mapping between the purchase price and the inventory which is there in the godown. So what standard says is will suggest certain cost formula which can be used for attributing cost to the inventories. Now what are those cost formulas? Specific identification method, Fifo method and weighted average price method. What is specific identification method? Now what is this specific identification method? In specific identification method, we try to find out the actual cost which was incurred to purchase the inventory in hand. That means we are going to one-to-one mapping between the purchase cost and the inventory which is there, or the cost of production and the inventory which is there. So we have to do one-to-one mapping between the cost and the inventory. So we have to find out what was the actual cost of purchase for the inventory or what was the actual cost of production for that inventory. Now, specific identification method means one-to-one mapping between cost and inventory. Now, when can it be used? Specific identification method is used when you purchase inventory for a specific project or a specific purpose. The goods are not interchangeable. You have small quantity but high value goods. The goods cannot be interchanged. The use is not similar. The goods are not similar. In such cases, we can apply specific identification method. I am giving you some examples. High value jewelry held by jewelers. So a jeweler has very few number of very high value jewelry. In such cases, suppose he has 4 different jewelry in his inventory. Jewelry 1, 2, 3, 4, and the value is very high. In such cases, he would like to value this jewelry based on its actual cost. So he would search for the invoice using which I had purchased that jewelry, or he would like to find out what was the actual cost of production for that piece of jewelry, and that will be considered as cost for that particular jewelry. Now, high value automobiles. So you are an automobile dealer, that means car dealer. You have purchased 4 or 5 very high value cars. Now, for these high value cars, you can see, suppose you have 4 or 5 varieties, A variety, B variety, C variety and D variety. The cost of D variety cannot have an impact on value of A variety. Cost of C car cannot have an impact on the value of B car. So we have to individually find out what was the purchase cost, and based on that we have to value the inventory. So specific identification method is used when there are small number of goods but they are of very high value, the goods are not interchangeable, they are not similar, then we are going to adopt the specific identification method. One more example, motors used in heavy equipment. Suppose there is a company which is manufacturing heavy equipment. They have purchased heavy duty motors. That means the size of the motor is big, the capacity of the motor is very high. Now this motor is unused at the end of the year. I want to know its cost. The cost of other motors which are of not the same size, not the same use, not of the same shape, those costs cannot have an impact on the valuation of this motor. So I would have to search for the invoice using which this motor was purchased, and based on that invoice I have to value this motor. So that is called a specific identification method. Now, specific identification method is used to stop a particular mischief. See, what may happen is, if you are having high value goods which are not interchangeable, what may happen is, the method of consumption or method of selecting the goods to remain in inventory can be used for manipulation of profits. So let us say a company has purchased high value goods throughout the year, some goods at the beginning of the year at a low price and at the end of the year at a high price. Now what may happen is, if the company is not adopting specific identification method, what the company may do is, wantedly they may consume goods which were purchased at a low price so that the remaining goods are valued at a high price and the value of closing stock increases and the profits also increases. So what may happen is, if you suppose you do not apply specific identification method, what may happen is, suppose a company has a mixture of goods, some goods which are purchased at a low cost, some goods which are purchased at a high cost. Now what may happen is, company may wantedly consume the low value goods and keep the high value goods in stock, so that the value of closing stock is more. If the value of closing stock is more, the profits may go up. So that mischief can happen. So to stop that mischief, the standard says we have to follow specific identification method where the goods are small in number, they are not interchangeable, and they are of high value. In such case, it is better to apply the specific identification method and do not apply FIFO method or the weighted average price method. Now we will come to the next method, the next cost formula, FIFO. What is FIFO method? In FIFO method, we assume that the goods which have been purchased first are consumed first, or the goods which have been purchased first are sold first. That is the assumption which we make in FIFO method. You would have also learned FIFO method in your earlier classes as well. Now, is it allowed for tax computation? Yes, FIFO method is allowed for tax computation as well. Now, under FIFO method, we are assuming that the closing stock of inventory is left out of the most recent purchase. So, the closing stock is out of recent purchase, not from a very, we can say a very old purchase. So, we assume that the goods which have been purchased latest, recently, those goods are remaining in closing stock. All the goods that have been purchased earlier are assumed to be consumed first. That is the assumption under FIFO method. Now, what is the impact on value of inventory? If you are applying FIFO method, the impact on value of inventory is the inventory would be valued at recent prices, because we assume that inventory is left out of latest purchases. Hence, we are going to value inventory based on recent prices. Inventory would be shown in balance sheet at recent prices. That means there will not be much difference between the value of inventory you are showing in the balance sheet and the value in the market. So that is the advantage of using the FIFO method. Next, weighted average price method. Now, weighted average price method is generally followed for packaged inventory systems which are computer controlled. Okay. Under weighted average price method, what we do is we show inventory at weighted average cost per unit. Now, what is weighted average cost per unit? We take the cost price per unit of inventory which was there at the beginning of the year, cost price per unit of inventory purchased during the year, you find an average, and we use that average for the purpose of valuation of closing stock. So under weighted average cost method, you multiply the number of units in inventory with weighted average cost per unit. Weighted average cost per unit considers the cost price per unit of inventory which was there at the beginning of the year and cost price of units purchased during the year. These averages can be calculated at the time of each purchase. You have some inventory, you purchase some inventory. You will immediately calculate a new average. Or you can also calculate the averages periodically. What do you mean by periodically? We will take the cost per unit of opening inventory. We will add up the cost of various inventories, cost per unit of various inventories which have been purchased during the year, and we will calculate an average at the end of the year. Example, we will take opening stock cost using cost per unit at the beginning of the month, add total purchases during the month divided by total number of units purchased during the month plus opening stock units, you will arrive at the weighted average cost per unit. So weighted average cost per unit can be calculated periodically or on every shipment. That means every time you purchase inventory, you can also calculate the weighted average. So weighted average can be either calculated at every shipment or it can be calculated at the end of the month, that is periodically as well. So weighted average price method, under weighted average price method, inventory is valued using weighted average cost per unit, that is you multiply the number of units with weighted average cost per unit, which is based not only on the purchase during the year, it also considers the cost per unit of inventory which was there at the beginning of the year. So this is the example of, this is the meaning of weighted average price method. The value of inventory, when you have low inflation, the value of inventory will be similar to the value of inventory which you arrive using FIFO method. Okay. These methods you have already learnt in your earlier classes and in your we can say earlier lectures as well. So we will not go in detail with FIFO method and weighted average price method. Now the question comes, can we use a different cost formula? Suppose the question is, can a company use FIFO method for inventory A, weighted average price method for inventory B? For A type of material FIFO method, for B type of material weighted average price method. The standard says yes, it is allowed. Now the answer is yes, depending upon nature and use. If the nature of the products, if the nature of inventory is different, use to the entity is different, in such cases definitely it is allowed to use various cost formulas for arriving at inventory. But the answer is no. Just because the company is having activities at various geographic locations, you have activity in India, you have activity in US, you have activity in UK, just because you have activities in different geographic locations, based on this argument you cannot use different cost formulas, or you cannot say that based on tax computation. See, the tax rules in India may allow FIFO method. The tax rules in US allows LIFO method as well. So, because there is a difference in tax computation, tax rules, you cannot change the method of valuation. So, because of difference in geographic location, because of difference in tax rules, you cannot apply different cost formulas. Yes, based on differences in nature, differences in use, yes, you are allowed to use different cost formulas. This is what the standard says. Okay. So, with this we finish how to, we have finished the discussion on the various methods which are allowed for ascertaining cost, the various cost formulas which are used for ascertaining cost. We can say these are approximation techniques. If the answer is not approximate to actual cost, then definitely you would have to apply some other method to arriving at the cost of production of finished goods or the cost of production of the work in progress which is there. Wait, now when will we adopt the standard cost method, retail price method? We have learned standard cost method will be applied for finished goods, semi-finished goods. Retail price method will be adopted by retailers. Now when will we use FIFO method, weighted average price method? Now we have learned that specific identification method would be adopted when we have very less number of goods of high value where they are not interchangeable. So when can you adopt FIFO method and weighted average price method? The standard says where you have large number of goods, the use is similar, the goods are interchangeable. In such cases, we can adopt the FIFO method and the weighted average price method. But in the case of specific identification method, only for small number of goods which are not interchangeable, you can adopt specific identification method. So when the goods are large in number, they are of similar use, they are interchangeable, definitely we can adopt the FIFO method and the weighted average price method to arrive at the cost. So with this we finish the lecture on determination of cost. We have discussed what are the various methods used and what are the various cost formulas permitted by the standard. Thanks a lot.